Welcome back to The Explainer. Today, we're taking a pretty fascinating journey, looking at the high-level macroeconomic forces shaping our world right now and tracing those exact forces all the way down to the micro-level realities of our wallets, our wealth, and, believe it or not, even our kitchens. Let's dive right into this together.
Here's our roadmap for the journey ahead. First, the big economic picture. Second, navigating the housing market. Third, the wealth forecast. And fourth, some sweet hacks and next steps.
Section 1. The big economic picture. Macro forces at play. To kick things off, we really need to understand the massive tug-of-war happening right now at the Federal Reserve. It's a delicate balancing act, and the economic data we're looking at today shows exactly why they are sweating.
So check out the headline number staring right back at us for Personal Consumption Expenditures, or PCE, for April 2026. Headline annual inflation actually ticked higher to 3.8%. Now, technically, this matched estimates. The market fully expected this. But matching an elevated estimate doesn't exactly make things easier, right? It keeps the pressure firmly on policymakers. Let's quickly demystify some of the jargon here, because the headline number isn't the only thing the Fed is watching. They care deeply about core PCE. This is the Fed's absolute preferred inflation measure, mostly because it strips out the volatile, day-to-day swings of things like food and energy prices to give us a truer trend line. For the month of April, core PCE only rose a moderate 0.2%, which is actually slightly cooler than forecast. But here's the catch. The annual rate edged up to 3.3% from 3.2%. And remember, the Fed's long-term target is 2%, so we're still well above that mark.
So, the absolutely crucial point here is understanding the extreme tension the Fed is facing right now, especially ahead of Fed Chair Kevin Warsh's first meeting coming up on June 16th and 17th. On one side of the scale, you have persistent elevated inflation that is practically screaming at the Fed to hold off on any interest rate cuts. Plus, renewed tensions in the Middle East have kept energy prices right in focus. But then, on the exact opposite side of the scale, we're seeing signs of a softer, cooling labor market, and that is pleading for those rate cuts to stimulate the economy. It is a classic, high-stakes standoff.
Let's see how this builds into the broader economic snapshot. We just got the second estimate for Q1 2026 GDP, showing the U.S. economy grew at a 1.6% annualized pace. That's solid. And it's largely being driven by massive, continued AI-related investment, along with a rebound in government spending. But look at the employment data. Initial jobless claims edged up to 215,000. And more importantly, continuing claims rose to 1.786 million. That elevated number for continuing claims, that's a huge signal. It suggests that while people might be picking up gig work initially, those who are actively seeking full-time jobs are taking much, much longer to find new employment.
Section 2. Navigating the housing market, sales and inventory data. Now, let's zoom in from that macroeconomy tug-of-war to see exactly how this tension is impacting the real estate market.
First up, we have to acknowledge a bit of a headline shocker. After 2 months of solid gains, new home sales declined 6.2% in April to a 622,000 annual pace. That was well below expectations and actually 11.3% lower than a year ago. According to the National Association of Home Builders, this slowdown was driven directly by those higher mortgage rates we've been seeing, alongside elevated gas prices that are really weighing on buyer activity.
But there's another bottom line here that completely changes how we view that drop in sales. Out of the 489,000 new homes available nationwide, the overwhelming majority aren't even ready to be lived in. We've got 256,000 currently under construction and 111,000 that haven't even been started yet.
Let me really hammer home the reality of this supply squeeze. 122,000. Out of the entire nation, across all 50 states, there are only 122,000 fully completed, move-in-ready new homes sitting on the market. That is an unbelievably low number, and it represents a massive bottleneck in housing supply.
Section 3. The wealth forecast, building home equity. Let's dial down even further. What does that massive supply squeeze actually mean for your personal wealth horizon? Because this is where the data gets truly empowering. Despite the volatility we just saw in sales volume, that incredibly limited supply continues to support steady, albeit modest, home price appreciation. The latest Case-Shiller Index, which is a leading measure of U.S. home prices, shows home values remain 0.7% higher than a year ago. Separate data from the Federal Housing Finance Agency shows a really solid 1.7% annual gain for homes backed by conventional loans.
So even when sales slow down, the sheer lack of supply puts a very firm floor under property values. And the data brilliantly illustrates where we're heading. Take the Fannie Mae and Pulsonomics Home Price Expectation Survey, which pools forecasts from over 150 economists and market strategists. They project a cumulative home price growth of 14% over the next 5 years. To put that in real dollars for you, if you own a $500,000 home today, that 14% growth literally adds $70,000 to your net worth over the next 5 years. That is passive wealth accumulation at its absolute finest.
So here is the ultimate bottom line for your personal wealth horizon. Despite economic chaos, despite fluctuating interest rates, and despite all those wild inflation headlines, homeownership remains a phenomenal financial anchor. Limited move-in-ready supply combined with underlying demand means housing is absolutely still one of the most powerful long-term wealth-building assets available to us.
Briefly looking at the technical picture driving those mortgage rates. Mortgage bonds have rebounded nicely recently, finding strong support right at their 50-day moving average, which is just a key short-term trend indicator used by traders. Meanwhile, the 10-year Treasury yield is trading in a very tight range, also hovering with support at its 50-day moving average. It's basically a technical standoff, perfectly mirroring the economic standoff we were discussing earlier.
Section 4. Hacks and Next Steps. Lemons and Labor Data. Okay, to transition from those dense technicals, we're zooming all the way into your kitchen for a quick, delightful palate cleanser. It's National Lemon Month, and we have a brilliant family hack to celebrate.
If you want to impress your family this weekend, check out this foolproof recipe for lemon poppy seed muffins. It's just 4 super easy steps. First, whisk your wet ingredients, including some fresh lemon zest. Second, mix your dry ingredients in a separate bowl. Third, blend them all together with a nice splash of buttermilk. And finally, bake at 350 degrees. Let them cool, drizzle on a simple glaze, and boom, you've got the absolute perfect weekend treat.
Pivoting rapidly back to the markets from the kitchen, here is your clear roadmap for the week ahead. Get ready, because we are getting a tidal wave of crucial labor data. Tuesday brings job openings, Wednesday drops private payrolls, Thursday gives us the weekly unemployment claims, and then, the grand finale, Friday's closely watched jobs report, giving us non-farm payrolls and the official unemployment rate.
Which brings us to our final thought. We started out today by looking at the massive tug-of-war at the Federal Reserve. Sticky inflation on one side, a cooling labor market on the exact other. So how will Friday's jobs report tip those scales ahead of Kevin Warsh's June meeting? Will it show enough weakness to force a rate cut, or will strong employment data give the Fed the cover they need to keep rates higher for longer? Keep your eyes locked on that data, because it's going to set the tone for everything we just discussed. Thank you so much for joining me on this explainer, and keep learning.